Question 1. Which of the following statements is true regarding municipal bond interest income for an investor? A. It is always exempt from federal, state, and local income taxes. B. It is typically exempt from federal income tax, but may be subject to state and local taxes. C. It is taxable at the federal level, but exempt from state and local taxes. D. It is always taxable at all levels of government. Answer: B. It is typically exempt from federal income tax, but may be subject to state and local taxes. Interest income from municipal bonds is generally exempt from federal income tax, which is a major appeal for investors. However, whether it is exempt from state and local taxes depends on where the bond is issued and where the investor resides. For instance, a resident purchasing a bond issued by their own state or municipality typically receives triple tax exemption. This tax benefit makes municipal bonds particularly attractive to investors in high-income tax brackets, as the tax-free return can be equivalent to a higher taxable return. Remember that capital gains from selling municipal bonds at a profit are always taxable at all levels, just like other securities. Question 2. A municipal bond's official statement, OS, would be considered which of the following? A. A preliminary prospectus for a new issue. B. The disclosure document for a new issue. C. An annual report detailing the issuer's financial performance. D. A quarterly filing with the Securities and Exchange Commission, SEC. Answer: B. The disclosure document for a new issue. The official statement, OS, serves as the primary disclosure document for a new municipal bond issue, providing investors with detailed information about the issuer and the bond itself. It contains crucial data such as the bond's purpose, repayment sources, creditworthiness, and any relevant legal opinions, allowing investors to make informed decisions. Unlike corporate securities, municipal bonds are exempt from SEC registration, so the OS is the comprehensive substitute for a prospectus. Understanding the contents of the official statement is vital for assessing the risk and potential return of a municipal bond. Question 3. An investor living in New York City purchases a general obligation bond issued by the state of New York. This bond would typically be: A. Subject to federal income tax only. B. Subject to state and local income taxes only. C. Exempt from federal, New York State, and New York City income taxes. D. Exempt from federal income tax, but subject to New York State and New York City income taxes. Answer: C. Exempt from federal, New York State, and New York City income taxes. This scenario describes a triple tax exempt bond. When an investor purchases a municipal bond issued by their own state and, if applicable, their own city, the interest income is typically exempt from federal, state, and local income taxes. This localized tax advantage is a significant benefit for residents of high-tax states and cities like New York. The key here is the investor's residency matching the bond's issuer. Question 4. Which of the following municipal bonds is backed by the full faith and credit of the issuing municipality, including its taxing power? A. Revenue bonds. B. Industrial development revenue bonds. C. General obligation bonds. D. Special assessment bonds. Answer: C. General obligation bonds. General obligation, GO, bonds are a type of municipal bond backed by the full faith and credit of the issuing municipality, which means they are secured by the issuer's power to tax its residents. This broad taxing authority, typically including property taxes, ad valorem taxes, provides a strong backing for the bond, making them generally considered safer than revenue bonds. Investors often view GO bonds as having lower credit risk due to this comprehensive pledge of government revenue. Question 5. A municipal bond with a par value of $5,000 is quoted at 102. What is the dollar price of this bond? A. $102. B. $510. C. $5,100. D. $5,010. Answer: C. 5,100. 100. Municipal bond quotes are typically expressed as a percentage of par value, where 100 represents par. 1,000 for standard bonds or $5,000 in this specific question. To find the dollar price, you multiply the par value by the quoted percentage. In this case, a $5,000 par bond quoted at 102 means 102% of $5,000, which calculates to $5,000 asterisk 1.02 equals $5,100. Understanding how to convert percentage quotes to dollar prices is essential for all bond calculations. Question 6. A municipal bond that has been escrowed to maturity is considered: A. To have a call feature that can be exercised at any time. B. To be in default due to missed interest payments. C. To be pre-refunded and now secured by U.S. government securities held in an escrow account. D. To be unrated and therefore carries higher credit risk. Answer: C. To be pre-refunded and now secured by U.S. government securities held in an escrow account. When a municipal bond is escrowed to maturity, or pre-refunded, it means the issuer has deposited U.S. government securities, or other highly rated securities, into an escrow account sufficient to cover all future debt service payments until the bond matures. This effectively removes the original issuer's credit risk, as the bond's repayment is now backed by the full faith and credit of the U.S. government. For investors, this makes the bond extremely safe and often results in a higher credit rating, despite the bond still being legally outstanding. Question 7. All of the following are typically sources of revenue for revenue bonds, except: A. User fees from the project being financed. B. Lease payments from the project being financed. C. Ad valorem taxes. D. Tolls collected from a new bridge. Answer: C. Ad valorem taxes. Revenue bonds are distinct from general obligation bonds because their debt service is paid only from the specific revenues generated by the project they finance. Examples of such revenues include tolls from a bridge, user fees from a hospital, or lease payments from a stadium. Ad valorem taxes, which are property taxes, are the primary revenue source for general obligation bonds, not revenue bonds. This distinction is crucial because the security behind a revenue bond is dependent solely on the success and profitability of the specific project. Question 8. What is the primary purpose of the bond counsel's legal opinion in a municipal bond issue? A. To set the interest rate for the bond issue. B. To determine the bond's credit rating. C. To attest to the legality and tax-exempt status of the bond issue. D. To market and distribute the bonds to investors. Answer: C. To attest to the legality and tax-exempt status of the bond issue. The bond counsel provides a critical legal opinion for a municipal bond issue, affirming that the bond is legally issued and that the interest income is exempt from federal income tax. This opinion is typically included in the official statement and is essential for attracting investors, as it provides assurance regarding the bond's tax treatment and overall validity. Without a clean legal opinion, the marketability of a municipal bond issue would be severely hindered. Question 9. An investor in a high federal income tax bracket would most likely prefer which of the following bonds? A. Corporate bonds. B. U.S. Treasury bonds. C. Municipal bonds. D. Agency bonds. Answer: C. Municipal bonds. Investors in high federal income tax brackets typically prefer municipal bonds because the interest income they generate is usually exempt from federal income tax. This tax exemption can provide a significantly higher after-tax yield compared to taxable bonds, even if the municipal bond's stated yield is lower. For example, a 3% tax-free municipal bond might provide a better after-tax return for a high-income earner than a 5% corporate bond, effectively increasing their net return. Question 10. The Municipal Securities Rulemaking Board, MSRB, has authority over all of the following, except A. Municipal bond dealers. B. Municipal advisors. C. Issuers of municipal securities. D. Underwriters of municipal securities. Answer: C. Issuers of municipal securities. The Municipal Securities Rulemaking Board, MSRB, is authorized to regulate municipal securities firms, including brokers, dealers, and municipal advisors, in their municipal securities and advisory activities. However, the MSRB does not regulate the municipal bond issuers themselves. Issuers are subject to their own state and local laws. This distinction is important for understanding the scope of MSRB's regulatory reach. Question 11. Which of the following risks is most associated with a municipal bond that has a lengthy maturity date? A. Credit risk. B. Liquidity risk. C. Call risk. D. Interest rate risk. Answer: D. Interest rate risk. Interest rate risk is the risk that changes in market interest rates will affect the value of a bond, and it has a greater impact on bonds with longer maturities. When interest rates rise, the market value of existing bonds with lower fixed interest rates will fall, and this decline is more pronounced for long-term bonds. This is because the investor is locked into a lower rate for a longer period, making the bond less attractive compared to new issues. Question 12. Which of the following would be found on a municipal bond confirmation? A. Underwriter's concession. B. Dated date. C. Accrued interest. D. Legal opinion. Answer: C. Accrued interest. A municipal bond confirmation, which is the document sent to a customer after a trade, must include details of the transaction. Accrued interest is the interest that has accumulated since the last interest payment date and is owed by the buyer to the seller, so it must be calculated and displayed on the confirmation. The dated date, underwriter's concession, and legal opinion are generally part of the initial bond offering and not typically found on individual customer trade confirmations. Question 13. A municipal bond's yield to call, YTC, would be quoted instead of its yield to maturity, YTM, when the bond is trading at A. Discount and callable. B. Premium and callable. C. Par and callable. D. Discount and not callable. Answer: B. Premium and callable. When a municipal bond is trading at a premium, above par, its yield to call, YTC, is typically quoted because the issuer is likely to call the bond at the earliest possible call date to reduce their interest expense. If the bond is called, the investor will receive par value, which is less than the premium they paid, resulting in a lower actual return than the yield to maturity would suggest. The yield to call represents the lowest possible return an investor could receive if the bond is called. Question 14. What is the purpose of municipal bond insurance? A. To guarantee the bond's market price will not fluctuate. B. To ensure the bond's interest income remains tax-exempt. C. To back the timely payment of principal and interest. D. To ensure the investor's principal against capital losses. Answer: C. To back the timely payment of principal and interest. Municipal bond insurance provides an unconditional guarantee that the insurer will pay scheduled principal and interest payments if the issuer defaults. This insurance enhances the credit quality of the bond, often resulting in a higher credit rating and lower borrowing costs for the issuer. While it doesn't prevent price fluctuations or guarantee tax-exempt status, it significantly reduces the credit risk for investors by providing a fallback if the municipality cannot meet its obligations. Question 15. The calculation for tax-equivalent yield on a municipal bond requires which of the following? A. The bond's coupon rate and the investor's capital gains tax rate. B. The bond's coupon rate and the investor's ordinary income tax bracket. C. The bond's yield to maturity and the investor's ordinary income tax bracket. D. The bond's coupon rate and the prevailing market interest rates. Answer: C. The bond's yield to maturity and the investor's ordinary income tax bracket. The tax-equivalent yield calculation helps investors compare the return of a tax-exempt municipal bond to a taxable bond. It requires the municipal bond's actual yield to maturity is preferred for accuracy, and the investor's marginal ordinary income tax bracket. The formula is municipal yield / 1, investor's tax bracket, which shows what a taxable bond would need to yield to equal the tax-exempt municipal bond's return. This calculation is crucial for suitability for investors in different tax brackets. Question 16. A local airport authority issues bonds to finance improvements to its runways, with the debt service paid from landing fees and concession revenues. This is an example of A. General obligation bond. B. Moral obligation bond. C. Revenue bond. D. Double-barreled bond. Answer: C. Revenue bond. This bond is a classic example of a revenue bond because the debt service is specifically funded by the revenues generated by the project itself, in this case, landing fees and concession revenues from the airport. Revenue bonds are not backed by the general taxing power of the municipality, making their creditworthiness dependent solely on the financial success of the specific enterprise. This focus on project-specific income distinguishes them from general obligation bonds. Question 17. Which of the following is most closely associated with the dated date of a municipal bond? A. The first interest payment date. B. The maturity date of the bond. C. The date from which interest begins to accrue. D. The date the bond is officially delivered to the underwriters. Answer: C. The date from which interest begins to accrue. The dated date of a municipal bond is the date from which interest begins to accrue, regardless of when the bond is actually issued or delivered. This date is important because it determines when the first interest payment period starts and how much accrued interest a buyer will owe the seller if they purchased the bond between interest payment dates. Think of it as the starting point for calculating interest. Question 18. An overlapping debt refers to A. Debt shared by two or more municipalities that occupy the same geographic area. B. Debt that has been refinanced with a new bond issue. C. Debt of a municipality that also includes its general obligation bonds and revenue bonds. D. Debt that is secured by multiple revenue streams. Answer: A. Debt shared by two or more municipalities that occupy the same geographic area. Overlapping debt refers to a situation where multiple taxing authorities, such as a city, county, and school district, share the same geographical area and can all levy taxes on the same property owners. When analyzing the creditworthiness of a municipality's general obligation bonds, it's important to consider overlapping debt because it represents the total tax burden on the residents within that shared jurisdiction. This collective burden could impact the municipality's ability to raise further funds or service its existing debt. Question 19. A bond rating organization, such as Moody's or S&P, evaluates which of the following for municipal bonds? A. The marketability and liquidity of the bond. B. The creditworthiness and ability of the issuer to meet its obligations. C. The tax-exempt status of the interest income. D. The yield to maturity and current market price. Answer: B. The creditworthiness and ability of the issuer to meet its obligations. Bond rating organizations like Moody's and Standard & Poor's assess the credit risk of municipal bonds by evaluating the issuer's financial strength and its capacity to make timely principal and interest payments. A higher credit rating indicates a lower risk of default and typically results in lower interest rates for the issuer and greater appeal for investors. Investors rely on these ratings to gauge the safety of their investment. Question 20. Which of the following best describes the role of a municipal syndicate? A. To provide legal advice to the bond issuer. B. To rate the creditworthiness of the municipal bond issue. C. To distribute the new municipal bond issue to investors. D. To ensure the principal and interest payments of the bond. Answer: C. To distribute the new municipal bond issue to investors. A municipal syndicate, also known as an underwriting syndicate, is a group of broker-dealers that come together to purchase a new municipal bond issue from the issuer and then distribute it to individual and institutional investors. The syndicate manages the offering, sets the initial price, and assumes the risk of selling the entire issue. This collaboration allows for efficient distribution of large bond offerings. Question 21. What is the typical tax status of industrial development revenue bonds, IDRs? A. Always fully tax-exempt at all levels. B. Subject to the alternative minimum tax, AMT, for high-income investors. C. Fully taxable at the federal level, but exempt at state and local levels. D. Always fully taxable at all levels. Answer: B. Subject to the alternative minimum tax, AMT, for high-income investors. Industrial Development Revenue Bonds, IDRs, or private activity bonds, are municipal bonds where the proceeds are primarily used to finance a facility for a private corporation, and the debt service is paid by that corporation. While the interest on IDRs may be tax-exempt at the federal level for most investors, it can be considered a tax preference item for high-income individuals, potentially subjecting them to the alternative minimum tax, AMT. This makes them less attractive to certain high-net-worth investors than other types of municipal bonds. Question 22. A short-term municipal note issued in anticipation of receiving future federal transit grants is known as A. TAN, Tax Anticipation Note. B. RAN, Revenue Anticipation Note. C. BAN, Bond Anticipation Note. D. GAN, Grant Anticipation Note. Answer: D. GAN, Grant Anticipation Note. A Grant Anticipation Note, GAN, is a short-term municipal security issued by a municipality in anticipation of receiving funds from future federal or state grants. These notes provide interim financing until the anticipated grant money is received. Each type of short-term municipal note, like TANs, taxes, RANs, revenues, and BANs, future bond issues, is named for the specific future income stream that will be used to repay it. Question 23. Which of the following is a characteristic of a moral obligation bond? A. It is backed by the full faith and credit of the issuing municipality. B. It is secured by specific project revenues only. C. If revenues are insufficient, the state legislature may appropriate funds to pay debt service, though they are not legally obligated. D. It is guaranteed by a third-party insurance company. Answer: C. If revenues are insufficient, the state legislature may appropriate funds to pay debt service, though they are not legally obligated. A moral obligation bond is a municipal revenue bond that carries a non-binding pledge from the state legislature to cover debt service if the project revenues are insufficient. While the state is not legally compelled to make the payments, there is a strong moral incentive to do so to preserve the state's credit rating. This makes them somewhat more secure than pure revenue bonds but less secure than general obligation bonds. Question 24. Build America bonds, BABs, issued after 2009 were unique because A. Their interest was fully tax-exempt at all levels for all investors. B. They were always subject to the alternative minimum tax, AMT. C. They were taxable to investors but offered a federal interest subsidy to the issuer. D. They were backed by the full faith and credit of the U.S. government. Answer: C. They were taxable to investors but offered a federal interest subsidy to the issuer. Build America bonds, BABs, were a special category of municipal bonds created under the American Recovery and Reinvestment Act of 2009. Unlike traditional municipal bonds, interest on BABs was taxable to investors. However, to compensate for this, the U.S. Treasury subsidized a portion of the interest payments made by the municipal issuer, making them an attractive financing option for municipalities. This made them unique in the municipal bond market. Question 25. All of the following are typically included in the net overall debt of a municipality when evaluating general obligation bonds, except A. Direct general obligation debt. B. Overlapping debt. C. Self-supporting revenue bond debt. D. Double-barreled bond debt. Answer: C. Self-supporting revenue bond debt. When analyzing the creditworthiness of a municipality's general obligation bonds, analysts consider the net overall debt, which typically includes the municipality's direct general obligation debt and any overlapping debt from other taxing authorities. However, self-supporting revenue bond debt is generally excluded from this calculation because these bonds are repaid solely from the revenues of the specific project they financed, not from the general tax revenues or full faith and credit of the municipality. This distinction helps investors understand the direct tax burden on the municipality's residents.